Debt is older than money, older than banks, older than written history itself. But something extraordinary happened in the last 350 years. Debt stopped being a temporary financial tool and became the permanent foundation of the global economy. Today, every country, every corporation, and every household is trapped inside a system that mathematically cannot be repaid. Not because people are lazy, not because governments are irresponsible, but because the system was engineered to function this way. A structure where debt is not a problem, but the very engine that keeps everything running. To understand how the world reached this point, we need to look at the long arc of financial history. Before the 1700s, monarchs borrowed money from merchants, nobles, and foreign banks. These loans had clear start and end points. They were repaid in full, or the king defaulted, and the cycle began again. There was no concept of permanent national debt, no expectation that governments should borrow endlessly. When debts became too large, lenders stopped lending and the system reset. That changed in 1694 when the English government, desperate for money to fund a war against France, accepted a proposal from a group of merchants led by William Paterson. They would lend the government $1.2 million, an enormous sum at the time. But on one condition: the government would pay interest forever and never be required to repay the principal. To administer this perpetual loan, Paterson proposed the creation of a new institution, the Bank of England. It would manage the debt, issue notes backed by it, and ensure the interest flowed every year. This was the birth of modern sovereign debt. Not a temporary tool, a permanent obligation, a promise from a government to its creditors that would last indefinitely. The logic was simple. Perpetual debt meant perpetual power. As long as the government could borrow, it could fight wars, build infrastructure, expand its influence, and project strength. And because the Bank of England could issue paper notes backed by government debt, money and debt became interchangeable. Borrowing no longer required real gold or silver. It simply required confidence. Other nations copied the model: France, Austria, Prussia, eventually the United States. What began as an emergency wartime tool became the financial backbone of modern states. By the early 1800s, global finance had transformed. Countries borrowed not to repay, but to refinance. Debt rolled over year after year, decade after decade, generation after generation. But sovereign debt alone did not trap the world. That required the next evolution: the industrialization of lending. In the early 19th century, the Rothschild banking network created a new system that allowed government debt to be traded across borders. British bonds could be bought by French investors. Austrian loans could be held by Dutch banks. Debt became an international commodity. And because millions of investors now depended on interest payments, a default was no longer just a political decision. It became a systemic threat. Once national debt became embedded in pension funds, insurance portfolios, and financial institutions, governments could no longer afford to default. They had created a world where their credibility and their people's prosperity depended on endless borrowing. Then came the third turning point: central banking. In 1913, the United States created the Federal Reserve. Other countries followed. Central banks had the legal authority to buy government debt with money created out of nothing. This changed everything. Instead of borrowing from private lenders, governments could borrow from their own central banks, who would then push interest rates down and expand the money supply. The cycle became self-reinforcing. More debt meant more money. More money required more debt to absorb it. Debt had transitioned from a tool to a requirement. The economy could grow only if borrowing continued. But the system became truly global after 1944, when the Bretton Woods Agreement established the US dollar as the world's reserve currency. Most countries held their savings in dollars, and because the dollar was backed by gold, foreign governments trusted it. But in 1971, when the United States abandoned the gold standard, debt became the only backing for global money. There was no longer any objective anchor. The world shifted into a purely fiat system, a system where money is created by borrowing and borrowing is required to prevent collapse. This is the heart of the debt trap. The global economy does not function unless debt grows constantly. If nations stopped borrowing, their economies would contract. If consumers stopped borrowing, spending would crash. If corporations stopped borrowing, growth would stall. Modern capitalism is fueled not by savings, but by credit expansion. And because debt must expand to keep the system alive, repayment becomes mathematically impossible. A world with $315 trillion of global debt cannot pay it down without destroying itself. If governments attempted to repay all their debt, the money supply would collapse. Banks would implode, markets would freeze, economies would plunge into depression. The debt is not meant to be repaid. It is meant to be rolled over indefinitely. This is why the world is trapped. Every solution feeds the problem. If central banks lower interest rates, borrowing increases. If they raise interest rates, debt becomes unpayable. If governments stimulate the economy, debt rises. If they cut spending, the economy contracts, and debt becomes heavier relative to GDP. This is the paradox. We are stuck in a system where debt is both the engine and the anchor. Without it, we collapse. With it, we slowly suffocate. But how did this become unavoidable? Because the people who built the system, bankers, central planners, political leaders, designed it intentionally. Perpetual debt means perpetual dependency. Governments depend on lenders. Lenders depend on governments. Citizens depend on both. Once a system reaches this stage, collapse becomes not a question of ideology, but of mathematics. The impossibility of repaying global debt is not a flaw of the system, it is the system. Once modern economies became dependent on continuous borrowing, the idea of reducing or eliminating debt became a political fantasy. Nations do not pay back their obligations, they rotate them, restructure them, inflate them, or extend them indefinitely. And because every major economy is doing the same thing, the global financial system has evolved into a delicate balancing act where everyone must keep borrowing to avoid the collapse that repayment would trigger. But debt dependency is only half the trap. The other half is interest, the silent force that transfers wealth upward continuously. Every dollar, euro, yen, or peso of debt generates interest payments that flow to the holders of that debt. Banks, asset managers, pension funds, sovereign wealth funds, and wealthy investors. The mechanism is self-reinforcing. As debt grows, interest grows. As interest grows, wealth concentrates. As wealth concentrates, governments borrow even more to fund basic services, widening the gap further. Over time, interest becomes a hidden tax. Citizens do not see it directly, but they feel its effects everywhere. Higher costs of living, slower wage growth, more austerity, higher taxes, fewer public services. A growing share of national income is diverted not to roads, schools, hospitals, and research, but to bondholders, often foreign ones. In some countries, interest payments consume more than military spending, education budgets, or national infrastructure. This is the second layer of the trap. Debt becomes a mechanism through which nations lose economic independence. Once a country reaches this stage, it becomes vulnerable to external pressure. When interest payments grow too large, governments face only three choices. 1. Borrow even more. This keeps the system running but accelerates long-term collapse. 2. Cut public spending. This sparks political unrest and weakens national stability. 3. Print money. This leads to inflation, currency deterioration, and reduced global trust. None of these options solve the underlying problem. They only postpone the consequences. This dynamic becomes globally dangerous when multiple nations are trapped simultaneously, which is exactly what we see today. The United States carries trillions in federal debt. Europe faces an aging population and shrinking productivity. Japan owes more than 250% of its GDP. China's property sector is heavily leveraged, and local governments depend on land sales and borrowing. Even developing nations are drowning in obligations denominated in foreign currency. The system requires continuous borrowing from every participant to stay alive. If any major economy stops borrowing, the shockwaves hit the entire structure. If several stop at once, collapse becomes inevitable. This is why international institutions, the IMF, World Bank, BIS, encourage borrowing rather than repayment. Repayment breaks the machine. Continued borrowing keeps it running. Nowhere is this more visible than in the developing world. Many poor countries accumulate so much external debt that they must borrow simply to pay interest on previous loans. This creates a cycle economists call debt servitude, where nations remain permanently dependent on lenders. The IMF's structural adjustment programs have locked dozens of countries into multi-decade repayment schedules that drain national budgets and suppress development. Roads, hospitals, schools, power grids, all are underfunded because interest comes first. This pattern is not new. It mirrors the financial colonialism of the 19th century, when European empires used debt as a tool of control. Today, the empire is not a single nation, but the global financial system itself. A network of institutions whose power grows as debt grows. At the same time, corporations have adopted the same model. Many of the world's largest companies survive not through productivity, but through borrowing and refinancing. Corporate debt in the United States has reached record levels. Major firms issue bonds to buy back their own stock, boosting share prices artificially. This strategy works only as long as interest rates stay low. When they rise, corporations face a crisis. Refinancing becomes more expensive, profits shrink, and layoffs begin. This is the third layer of the trap. Modern capitalism rewards borrowing over productivity. Companies that take on massive debt appear more competitive than companies that operate conservatively. Governments that spend through borrowing appear more successful than governments that budget responsibly. Consumers who borrow appear wealthier than those who save. Debt becomes a substitute for real value, and the system rewards it at every level. But what happens when borrowing stops? What happens when interest rates rise, or lenders retreat, or confidence breaks? The answer is what we saw in 2008, a cascade effect. One sector collapses, then another, then another. Banks freeze, credit tightens, corporations fail, consumers panic. At the heart of every financial crisis is a simple fact. The world depends on debt expansion, and when the expansion pauses, the economy seizes like an engine without oil. This brings us to the most dangerous element of the debt trap. There is no clean exit. Debt can be inflated away, but inflation destroys purchasing power and destabilizes nations. Debt can be defaulted on, but defaults trigger contagion and wipe out financial systems. Debt can be refinanced indefinitely, but that delays collapse while making the eventual reckoning larger. The world has reached a stage where debt grows faster than GDP in nearly every major economy. Historically, when a nation's debt exceeds its productive output, the system begins to fail quietly. Growth slows, inequality widens, social tensions rise, political polarization intensifies. Eventually, trust breaks down. This is where the debt trap intersects with the imperial pattern. Late-stage empires drown in obligations they cannot escape. Rome debased its currency. Britain borrowed heavily during its decline. The Soviet Union collapsed under economic strain. The United States is now the anchor of the global debt system, but also its greatest vulnerability. If the dollar loses credibility, if US debt becomes unstable, the entire global order shakes. Debt is no longer a tool of growth. It is a cage, and the longer the world stays inside it, the harder the exit becomes. The next major financial crisis, whether triggered by sovereign defaults, banking failures, currency instability, or geopolitical shocks, will expose how fragile the system has become. The final question is not whether debt will break, but how. Will it break through inflation, erasing savings? Will it break through defaults, erasing trust? Will it break through currency collapse, erasing value? Or will it break through a systemic reset, a redesign of the entire monetary order? History shows that every debt cycle ends. No system can expand forever. The question is whether the world is prepared for what comes after. Because once the debt trap snaps, nothing returns to what it was before.